For a long time, corporate finance relied on monthly cycles, with key financial information updated only once or twice a day, and reports refreshed overnight. But today's business environment moves much faster, with unpredictable changes in rates, tariffs, supply chains, and increased competition driven by AI shrinking decision time from weeks down to minutes. To keep up, finance leaders are building real-time capabilities across cash management, risk control, working capital, forecasting, and performance tracking. Surveys and industry experts show that CFOs now focus heavily on scenario planning, agile governance, and continuous data to handle uncertainty and respond quickly to changes in liquidity and risk. At the same time, AI and automation are expected to boost productivity by combining real-time data from banks and ERP systems with predictive models and automated controls. This new approach isn't just a software upgrade, it's a shift to a new way of working that streamlines decisions as the business operates. For example, having real-time cash visibility enables treasurers to move surplus funds into investments or repay debt the same day, reducing idle cash and interest costs. This is supported by cloud treasury platforms and APIs that provide instant updates across multiple banks. Live liquidity data also helps improve scenario planning and short-term funding decisions, which is crucial with inflation still impacting capital allocation. Additionally, Deloitte's research highlights growing adoption of advanced scenario planning and agile governance, both of which depend on high-quality, real-time data inputs like orders, shipments, and currency rates to improve forecasting and manage risk more effectively. Overall, moving to real-time corporate finance offers more precise control over liquidity and faster, better-informed decisions in a rapidly changing world. Asset managers are now focusing on selective risk-taking driven by timely data, using AI to quickly interpret signals from small details up to larger market trends. Corporate finance can apply this approach to improve pricing, hedging, and managing inventory. When it comes to working capital and customer experience, using streaming order-to-cash and procure-to-pay data helps identify stuck invoices, approval delays, or early payment chances almost in real time, which improves metrics like days sales outstanding and days payable outstanding without the usual end-of-period pressure. Embedded finance and instant settlements also play a key role in reducing friction for customers and suppliers, something that's especially important as value and reliability influence purchasing behaviors early in the year after the holidays. On control, compliance, and cyber resilience, moving to automated, continuous controls instead of periodic checks lowers the effort needed for compliance and helps spot issues faster. Regulatory technology adoption keeps growing as rules become more complex. Given the increased cyber risk in financial operations, implementing zero-trust security models and real-time monitoring is essential. To build real-time corporate finance, start by defining the key decision moments and associated KPIs where timing is critical, such as intraday liquidity or FX exposure limits, making sure each is linked to a decision owner, SLA, and alert. This connects technology development to measurable results and aligns with C.F.O.'s current priorities. Next, modernize your data infrastructure by integrating banking APIs and open banking rails for live financial data and setting up streaming pipelines using tools like Event Hubs or Kafka equivalents to handle high-frequency operational data like orders and point-of-sale transactions, feeding all of this into a centralized finance data environment. Current trends show a shift from using fragmented spreadsheets towards adopting unified CPM and DPM platforms that integrate planning, consolidation, and reporting, establishing a single source of truth. Automating the close and controls is essential. This includes continuous account reconciliation and auto-matching between banks and the general ledger, so that the month-end close becomes a confirmation step rather than a discovery process. Real-time policy checks help catch issues like credit limit breaches, duplicate invoices, and segregation of duties violations immediately through instant alerts. AI plays a growing role in forecasting and anomaly detection by moving organizations from static budgets to rolling forecasts that update with real-time data on orders, inventory, labor, and macroeconomic signals. Finance leaders are prioritizing AI-assisted forecasting, which uses unsupervised models to detect outliers in spending or revenue leaks and supervised models to predict collections or customer churn. It's important to carefully manage governance here to ensure results are explainable and backed by audit trails, as this remains a challenge for many teams chasing AI benefits. Embedding decision-making within workflows reduces time wasted switching tools. Approval, hedging, and other actions can happen directly in dashboards or collaboration platforms like Teams and Slack. For pricing and inventory, linking finance signals to configure price quote and commerce systems allows changes to spread quickly but safely. Finally, Strengthening security and resilience is critical in today's environment by adopting zero-trust principles, multi-factor authentication, least privilege access, and continuous monitoring across ERP, treasury, and data platforms, especially given the rise in ransomware and attacks targeting CFOs. Building fail-safe processes with backup bank connections, data replay capabilities, and automated security response helps prevent outages that could disrupt treasury operations. Finance leaders are likely to broaden their roles by reskilling in areas like AI, data, and scenario modeling. This shift involves creating a dedicated finance data office and forming cross-functional teams that include treasury, IT, risk, and operations. These teams take responsibility for managing real-time financial data and outcomes. For example, a global consumer goods company tackled the issue of cash trapped in a complex, multi-bank, multi-currency environment by implementing APIs for real-time bank connectivity, delivering updates every 5 minutes, and integrating with their ERP for automated cash management. This reduced idle cash, lowered funding costs, and improved foreign exchange management. A mid-market manufacturer facing tariff and supply chain uncertainties built a streaming data pipeline from orders to logistics and adopted rolling forecasts with scenario options, which improved inventory management, accelerated pricing decisions, and reduced margin volatility. Lastly, a subscription software company addressed rising collections risk using machine learning models to score accounts daily, automating risk-based dunning and personalized offers through their CRM. This approach decreased days sales outstanding and stabilized revenue retention, demonstrating how AI-driven real-time analytics can enhance financial performance. Together, these examples illustrate how reskilled finance functions and integrated operating models are central to advancing real-time corporate finance. Real-time corporate finance brings several clear advantages. It allows finance teams to respond quickly to intraday changes in cash flow, foreign exchange, and demand, which is especially important as inflation and policy shifts make markets unpredictable. Forecasts improve too, as AI-assisted models update continuously with live operational and market data, increasing accuracy and confidence. Working capital management benefits from real-time spotting of disputes, approvals, or early payment discounts, which helps optimize day sales and purchases outstanding without the stress of end-of-quarter rushes. Compliance and risk management become more robust through continuous controls that catch fraud or policy breaches faster, a crucial factor given the rise of cyber threats. Furthermore, CFOs gain strategic flexibility, enabling them to take stronger stances on pricing, mergers and acquisitions, and capital deployment. On the other hand, challenges remain. Data fragmentation and poor quality can turn real-time updates into noise without a single, unified source of truth, requiring many companies to move away from scattered spreadsheets. Increased connectivity raises security and privacy concerns, making zero-trust policies and continuous monitoring a costly but necessary investment. Change management is another hurdle, since real-time processes require redefined decision rights and formal service-level agreements to avoid teams slipping back to slower, monthly cycles. AI models also pose risks if not properly governed, as they can mislead decisions and result in mediocre returns on investment. Finally, while comprehensive platforms can speed up implementation, they may limit future flexibility due to vendor lock-in and integration costs. Balancing these advantages and pitfalls is essential to leveraging real-time finance effectively. To successfully implement best-of-breed solutions, it's crucial to have strong integration and data engineering skills, and to make strategic trade-offs, especially when capital is tight. A practical approach is to follow a 90-day starter plan broken into 3 phases. In the first 30 days, focus on aligning outcomes by selecting 2 key decisions where timing is critical, such as daily cash positions and FX hedging thresholds, and define 5 to 7 real-time KPIs with alert thresholds, along with mapping owners and SLAs. In the next 31 to 60 days, work on connecting and cleaning data by enabling banking APIs for same-day balances and transactions, integrating ERP order, and accounts payable and receivable streams. Establish a lightweight lakehouse, even if it initially relies on nightly data feeds, and reconcile it to the general ledger to build trust. Start piloting continuous reconciliations for the top 5 cash accounts. In the final 61 to 90 days, automate processes and embed them by creating dashboards that offer one-click actions like sweeping, hedging, and approving transactions. Launch a rolling forecast for cash and revenue with weekly updates and scenario toggles. Set up governance frameworks including a model registry, data quality checks, security reviews, and a weekly report on decisions made. This phase plan reflects emerging CFO and FP&A trends toward unified platforms, rolling forecasts, selective AI, and measurable returns. Moving finance to operate at the speed of business means adapting to rapidly changing macro signals, customer demands, and supply chain disruptions. The benefits include lower funding costs, more precise pricing and hedging, healthier working capital, and a finance function that shapes strategy rather than just reporting on it. While this transformation demands investment in data infrastructure, security, and talent, organizations that successfully unify data, operationalize rolling decisions, and govern AI effectively will gain a durable competitive advantage by shifting from month-end processes to real-time decision-making.